Bonjour à tous. Hello, everyone. And thanks for joining our credit outlook for the end of the year 2025. It will be presented by Thibaut Cuilliere, head of our sector and credit research, Ivan Pavlovic, our specialist on energy and hybrids, and also Baptiste Reuillon, who recently joined us and is covering the banking sector. Voilà, we thought it would be a good timing after another wave of strong performance on spreads to see what could be the outcome for the last weeks and the last months of the year to either preserve performance or to see how to catch up. So voilà, our experts will share their views with you. If you have any questions, you can use the Q&R button questions, and we'll answer to these along the flow of the conversation. Thanks, everyone. Thibaut, floor is yours.
Yeah, thank you, Alexandre, and hello, everybody. So let's start with that credit outlook for year end. So I will start, obviously, with the strategy part on credit before leaving the mic to Ivan on energy and hybrids, and then Baptiste on financials. So if we start with credit, so obviously, as you mentioned, Alexandre, we had a nice performance on the year-to-date basis. So either in spread terms or in total return, so 2.7% of total return year-to-date for corporate investment grade in euro, which is quite nice. Even better for dollar ones, close to 6%, even more than 6% now. And around 4.4% of total return for euro high yield year-to-date, which is clearly a very good year so far. In terms of spread changes compared to swap, as you can see on that table. So if you look at the top line, you see the spreads as of yesterday night, and you can see the difference on the year-to-date basis on one of the second line below of the table. And what you see is that most of the segments have actually seen their spreads tighten versus swap, particularly high betas. So again, high betas were definitely the main outperformers of the market, but we have seen more differentiation by high beta, particularly. So AT1 have done really well. Then the Atrax crossover with 55 basis points of tightening on a whole corrected basis. But after that, and let's say far compared to AT1, far below our corporate hybrids and euro high yield, which is in the region of 35 basis points of tightening. On the senior side, as you can see there, we are more in the region of 15 to 20 basis points of tightening so far, with a slight outperformance of banks compared to corporates, particularly since last May. So obviously, the question we have behind is, are we too tight in credit valuations today? And particularly when you look at the chart below left-hand side, what you see is that on the high yield side, we are very close to the tightest point we have ever seen in spread versus swap for euro high yield, which is far from being the case in corporate non-financial senior investment grade on the other hand. So there is a big difference in terms of valuation still between IG and high yield, at least compared to swap. And the second thing, which is quite striking, is on the right-hand side. As you can see, there is still a big difference between the cash and the CDS market. Part of that, obviously, is attributed to the tension we have seen in sovereign spreads, which is what you can see with the light blue curve there. And obviously, cash spreads are more affected by the sovereign global widening we have seen over the past 2 years, and particularly the risk on France. We'll touch upon that later on. One of the factors fundamentally which explains why spreads are so tight on the credit market is obviously the fact that we have seen, and actually before what was expected by the market some time ago, credit conditions actually improving in the US, which is quite weird given the fact that in the same time tariffs are starting to apply. But as you can see on the picture left-hand side, what we see already coming from the senior loan survey in the US is the debt tightening of credit conditions applied to large and medium enterprise, but also small and medium enterprise, are actually slightly better than it was in Q1 25 already. Even though so far it's true that the demand which is coming from corporates in the US is pretty low, which is what you can see with the pink curve. But nevertheless, that is triggering a significant change, which is obviously positive for credit spreads and potential future defaults. Second thing, which is quite striking, is the chart on the right, showing that we have seen in 23 and 24, particularly delinquencies rising in the US, particularly with credit cards. And it's quite interesting to see that since the beginning of the year, actually what we see is a stabilization of delinquencies, but also charge-off in the US, either for credit cards, but also for commercial real estate and commercial and industrial loans, which obviously is a positive in a context where obviously tariffs have obviously started to rise in the US. Turning to Europe, if you look at that slide, what you see is that it's exactly the same picture. The bank lending surveys published by the ECB was actually showing some material net tightening of credit conditions at the end of 2024. But the signs we have seen so far this year are actually pointing into the right direction, which means looser credit conditions apply to companies, which is clearly what you can see on the chart left-hand side. And the future of credit standards applied to the approval of loans or credit lines, if you look at the picture right-hand side, is also favorable. All factors are actually pointing towards a net loosening of credit standards in Europe, which obviously is a positive for credit spreads. So this is for the fundamental part. The other thing which is obviously important to keep in mind is the fact that even though we have seen lots of supply for credit in general, with more than 60 billion of corporate supply, for instance, in September, which was a record month, nevertheless, when you look at the dynamic in terms of total debt for European corporates compared to European govies, on the chart left-hand side, what you see is that we have a kind of seesaw effect between the two, which is at the advantage of Euro non-financial corporate debt versus European government debt. And spreads are to a certain extent correlated to what is the share of corporate debt to total GDP in Europe, as you can see on the picture right-hand side. And that corporate debt to GDP is actually already getting lower, which is obviously not the case for govies. So in terms of global bond allocation for investors, obviously that makes sense to prefer credit when the supply for govies is still on a rising tone, while the supply for credits is actually slightly higher, but less high than it is for govies. The other point is technicals. So technicals are definitely very favorable for the credit markets at the moment. So you can see on that pictures actually what has been the change in terms of the inflows that we have received, or let's say that US credit funds have received on the chart left-hand side, and European credit funds have actually collected on the chart right-hand side. So those data are coming from LIPR-FMI and EPFR respectively. And what you clearly see there is that we have seen record levels of inflows. So we are around $15 billion in US high yield on a year-to-date basis, which is even above the levels we have seen last year at the same stage, around 14 billion. When you look at euro, we are around 43 billion year-to-date in IG funds, which is the best year since we have the statistics since 2016, actually. 17 billion more than last year to date in terms of inflows in European credit funds, IG. The same could be said for high yield ones, even though the trend has been a bit less favorable over the past 3 weeks, but still on a year-to-date basis, we are around 6.5 billion of net inflows, which is twice as much as what we have seen last year. So obviously, those technical factors have triggered a lot of demand for the credit market, which has helped, obviously, triggering more appetite and supply demand, obviously favoring that tightness in credit spreads. Last but not least, defaults are actually pointing towards the right direction, which means lower default. So it has actually taken a lot of time for a US high yield default rate to start getting lower, which is what you can see on the picture left-hand side. And over the past few months, Moody's have been constantly revising upwards its target for default rates. But we believe that we are at the end of that revision trajectory now. And as you can see, between May and August 25, actually Moody's has stabilized its target for the future default rate, which is clearly the case on the chart left-hand side. And it means that probably we will see default rate in the US getting lower, probably around 3.5% in 1 year time. The same could be said for Europe. probably in the next 6 to 9 months in the region of 2.5%, but the potential is definitely more limited there. But nevertheless, it's a positive factor. Last, ratings. In line with the trending default rate. So ratings have actually stabilized in corporates either in Europe or the US, as you can see on the picture left. So there is no material deterioration in ratings for US corporates there, despite the risk on the economy. And in financials, we are still in a very positive tone with much more upgrades than downgrades. So if we calculate the upgrade minus downgrade divided by upgrades plus downgrade on European financials, as you can see, we are in excess of upgrades by 55%, which is something we have not seen since 2019 at least. Same for US banks with better regulations that actually helped the market to recover in terms of ratings after the crisis in 2023 at the time of a regional bank crisis in the US. So obviously that's still a big difference between financials and corporates at the moment. So apart from those, let's say, fundamental and technical factors, let's do a slight focus on France, obviously because we have seen recently some new tensions arising on government spreads, but also on credit spreads coming from French corporates and banks, even though the month of September has been much better than it was at the end of August, where the tensions were there with less allocations, particularly on the deals that were issued from French corporates end of August. And this is due to the fact that, as you can see on that slide, there is a large share of French credits in the indices. So if we look at the share of French credits in the iBoxx indices, what you see is that on average, they account for around 25% of those indices, which makes France actually the biggest country in terms of country of risk for most of the credit indices, and that's particularly the case for sub-insurance and bank sub. But it's also the case to a certain extent in the iTraxx indices, as you can see there, around 20% of French credits that account for the new series of the iTraxx. And even though, so recently the tone has been actually slightly better for French credits, you need to keep in mind that if you look at the trend over the last 1 year and a half, so basically after the snap elections, which were decided by the President Macron, we have seen, that was back in June 24, we have seen long-term underperformance of French credits compared to their European counterparts. So as you can see on that picture, so we have looked at what is the senior preferred pickup versus France and the senior preferred pickup for banks versus the iBoxx senior preferred index, which is the purple curve, so left-hand side, and the same for non-financials on the chart right-hand side. So what you see is that we have seen an underperformance definitely over the past 1 year and a half of French credits, particularly the French banks, which has underperformed their European counterparts by around 12 basis points over the last 18 months. Only 6 basis points of underperformance for the French corporate non-financials. And this goes in line with the fact that the more the sovereigns is under pressure, let's say structurally, the less we have pickup and buffer in terms of spreads between the credit and its sovereign on same maturity, which is what you can see on the yellow curve there. So the spread pickup between the credit and the govies on same maturity is actually getting lower, and it's at its lowest over the past 3 years or even more actually. So that's creating some tensions, because it means that the more tensions potentially we could continue to see on the govie side for France, the more obviously credit might be affected, taking into account obviously that the sensitivity of French credits to the govies is more in the region of 0.4 times when it comes to the non-financial corporates in France, and around 0.9 when it comes to senior preferred bank debt in France, and even above 1 for the senior non-preferred. So twice as much of sensitivity for banks rather than for non-financials. And the question is, do we have enough buffer for French credits compared to their European counterparts if we compare the spreads with the respective govie spreads for same maturities. So the table on the right-hand side shows you how much of spreads do we have for French credit, non-financial one, divided by the maturity bucket and the rating bucket that we can compare with all corporate non-financials, which is the top part of the table right-hand side, and with the Italian ones, knowing that obviously recently what we have seen is that on the 10-year OAT, it's trading very close to BTP. So it makes sense to compare with the Italian credits there. And what you see is that the corporate single A's in France are actually giving less pickup than their Italian counterparts and less than their all corporate counterparts in Europe versus their respective govies. It's less the case for the triple Bs. But there is clearly an expensiveness of the single A rated French credit. So part of that is probably attributed to the fact that they have a very large diversification in terms of revenues. Usually the share of French revenues compared to the total revenues is between 15 and 20%. But still, we believe that there is a risk of tensions with knock-on effect coming from widening in sovereigns that will apply to the French credits with the sensitivities that I mentioned before. So that's a risk that an investor needs to keep in mind, particularly waiting for the final finalization of the French government now. If we turn to the credit allocation, so taking into account the macro scenarios coming from our US economists and European economists, as well as Asian economists, the targets we have for rates coming from our rate strategists, but also the targets for OAT Bund, which is going to be an important topic for credits for the reasons I mentioned before, with 25% of credits usually based in France. If we take all that into account, plus the scenarios we have also on the equity market, and if we try to integrate that in our long-term econometric models, what we see there is that we have probably are obviously difficult to factor in econometric models. Nevertheless, we have tried to do that there, as you can see there. The expected spread performance for the end 2025 is, to us, probably going to see a slight widening of credit indices, but that will be very differentiated on the high beta side. So slight underperformance of the low betas, 5 to 6 basis points for European IG spreads compared to swap, and 6 basis points for USD versus swap also, and more in the region of 20 basis points for corporate hybrids, which tend to be expensive. I will come back on that. But we continue to see, on the other hand, a nice performance to be expected on the additional tier 1 and sub-insurance, where the risk of widening will be largely offset by the carry generated by those instruments. So it makes sense to continue to be overweight in that part of the high beta of the market, but to take profits in corporate hybrids and in euro high yield from those levels, as you can see there. If we turn to the sector performance, so we have not seen so heterogeneous performance by sector on a year-to-date basis, despite the fact that it has been pretty volatile over time, particularly back in April, where tariff actually did significant underperformance of autos and auto parts at that time. But as you can see, on a year-to-date basis, we are very close sector by sector. If we look at the premium generated sector by sector now, what you can see on the chart left-hand side, and if we take into account the risk of tariffs to be applied, plus the cyclicality of sectors, the exposure to France, as well as the credit momentum sector by sector, what strikes us there is that we continue to see a good impact, let's say a good potential for outperformance of real estate overall, as you can see on the table right-hand side, which is the summary of our sector allocation there. So we would continue to be overweight in real estate, but with more differentiation by name than it used to be in the past. Mining sector is also a sector where we see a lot of value, and you can see that on the chart left-hand side, it still trades with 20 basis points of premium despite the fact that the sector is benefiting from large commodity prices, high commodity prices at the stage. Aerospace defense is definitely a sector where we see good value, thanks notably to the measures that will obviously reinforce the defense sector for Europe in 2025 and particularly for 26. Data centers, utilities, telecoms are sectors also that we would recommend overweighting in that environment, while on the other hand, chemical, capital goods, media, retail would be the sectors to underweight if we take all those factors into account. Turning to where do we trade in terms of spreads versus, let's say, the percentile over the last 20 years. As you can see, there are some differences by segments of the market, definitely. It looks like most of the high betas are trading very tight and very close to their tightest in history, which is the case for additional tier 1 and high yield euro. But if we look more into details, we actually believe, and Baptiste will come back on that for additional tier 1, that there is maybe not more significant potential for tightening, but at least justification for spreads of A tier 1 to be where they are today. So actually, our long-term model for A tier 1 is telling us that 280 basis points is a reasonable target for A tier 1, which is what you can see on the chart left-hand side. And it's particularly triggered by the fact that the price to book value for European banks has increased so much, chart on the right, that we are back to something we have never seen over the past 8 years at least, of a price to book on average around 1.45 for European banks. And obviously that is pushing valuations for A tier 1 much tighter than it used to be in the past. So that plus the fact that solvency ratios are very high at the moment, which means maximum distributable amount are also very comfortable for banks, means to us that the spreads could stay in the region of 270, 280 basis points for additional tier 1. So the carry plus the mark-to-market potential is actually making sure that we could keep the overweight stance on A tier 1. On the other hand, corporate hybrids look now a bit too expensive. So this is what I published actually back on Monday. So do not hesitate. If you have not received the paper, you can send me an email so that I can forward it to you. But what you can see on the picture left-hand side is that we are definitely too tight in corporate hybrid spreads now compared to our long-term model, chart left, which was not the case a couple of weeks ago. So the expensiveness actually reinforced over the past 4 to 5 weeks. And even the multiple of hybrid spreads compared to CDS for the same panel of names, same maturity, or let's say same call dates, actually show that on the chart right, that we are back to a level of expensiveness we have not seen since at least early 2023, which is, let's say, below 4 times multiple between hybrid and senior CDS, while we were above 4.5 times back in March 2025, for instance. So hybrids are starting to trade very expensive on average. So then it depends, first of all, on the maturity buckets, and second, on the names. Maturity buckets, if you look at those pictures there, what you see definitely is that the multiple of hybrids to senior continues to stay pretty attractive for maturities such as call dates of August 28, which is the sample we have considered there compared to August 30 maturities and August 32 call dates. And as you can see, there is no more big difference of spreads between hybrids with the same panel of names, August 23, August 30, August 32. So the difference is multiple of spreads compared to senior is now very high for August 28. Which means, as a consequence, that we see good potential for a couple of hybrids, as you can see on the top table there, on call dates in the region of 2028, 90, sometimes 29, 30. So those are the cheapest hybrids we see, namely IBOS, the IBOS caliber 27, 29, which is one of the names on which our real estate analysts are quite positive and continue to believe that the issuer will continue to keep its investment grade status, which will obviously be very important for the valuation of the hybrids. Some other names that appear there are Bayer, sometimes that appear cheap, Orsted 30, but Ivan will come back on that. Alstom callable 29, Arkema callable 29, for instance. On the other hand, the callable 26 or the callable 34, 35, 36 appear quite expensive there. So if we do the comparison by issuer call dates, without entering into too much detail, what you see there is, if I take, for instance, Total Energy, the hybrids are trading relatively cheap on call dates November 29 and June 30, but are trading very expensive on the long end of the curve, so the callable 34 and 36. So this is the perfect example of what I mentioned before, which is prefer the belly of the curve for hybrids and make sure that you can take some profits on the long end or the very short end of the curve. Same for Orange, where the cheapest on the curve is the callable February 29. Last thing on my side, so euro versus dollar credit arbitrage. It's quite interesting to compare the performance again with the same pattern of names that have been issuing in euro and dollar markets, same maturity. So what you see on the chart right-hand side particularly is that what we have seen recently is a large outperformance of dollar spreads compared to euro spreads for the same kind of names. And particularly in autos. So autos have massively compressed in dollar versus euro. It's not so much the case for telcos, particularly the European telcos. So it also depends on the sector. But globally, what you see, which is quite interesting also, is that we had in the past a nice correlation between the difference in spreads dollar versus euro and the forex euro dollar. And that, as you can see, that correlation actually stopped back in April 25, whereby we continued to see an appreciation of euro versus dollar, and our forex strategies actually Nordin NAM continues to see more appreciation of euro versus dollar in the future, which might trigger some underperformance of dollar spreads versus euro if we come back to that long-term correlation between the two. So that's one of the risks we see, an underperformance of dollar versus euro on a general basis. So then obviously, again, the devil is in the details. It will depend on the sectors and on the maturity of credits, but overall, we would say it's more on the long end of the curve that you have more risk of widening for dollar versus euro. And there are a couple of sectors where dollar is already quite attractive compared to its European counterparts for the same panel of names, and that's notably European autos, telcos, so European telcos, and healthcare, where the difference in spread between dollar and euro to us is enough to take the risk of a further depreciation of dollar versus euro. On the other hand, when one turns to oil, tobacco, and mining, then dollar is quite very expensive versus euro. So that's sectors where we would recommend to prefer the euro. So as you can see on those tables where we actually compare the spreads of euro by sectors and by maturity on the left with the spreads of dollar in the middle, looking at the difference. So sector by sector and maturity bucket by maturity bucket on the right-hand side of that table. Knowing that today the cross currency is actually quite negligible, fortunately. So it's making sure the exercise is easier to do in terms of calculations. Last, turning to the euro versus dollar, if you look at European banks, also that's quite interesting to see that despite the fact that we have seen a large compression in spreads, euro and dollar over the past 4 months, let's say the difference between dollar and euro for the same panel of European banks, senior non-preferred, is staying in the region of 40 to 50 basis points, which is quite large compared to some historical standards, and knowing that part of that difference in spreads is actually correlated to the level of spread itself, which means that there are potentially also on the banking sector some opportunities to seize in diversifying in the dollar market for investors. And that's notably the case if you look at the picture right-hand side on names such as ISPIM and BBVA, where spreads of dollar, as you can see, are far above the average curve of dollar versus euro spreads, while on the other hand, names which are well known on the dollar market because those are coming from global CIBs, such as BNP, Deutsche Bank, for instance, are usually trading a bit tighter in dollar versus euro compared to the rest of their European counterparts. So if you want to diversify in the dollar market, so take the opportunities of looking more at ISPIM, BBVA, and to a lesser extent Santander or ABN AMRO, for instance. And that's it for me, and I will hand over to Ivan before before going into the question and answers.
Thank you, Thibaut, and good afternoon all. So I'm very happy to be with you today to give you an overview on the utilities and oil and gas sectors. Probably a forward before I go into the presentation. We have expanded our sector coverage over the past few months by adding ENI on the oil and gas in the oil and gas sector, as well as Ørsted and ENBW in the utilities sector. So it's really that's part of our expanding mandate on single name research. Now, having said that, let us start with an overview of the H1 results in the two segments. Next slide, please, Thibaut. And I think that these results were uneventful, so no big surprise to report, with performances slightly down year on year for most players, and clearly reflecting a negative basis for comparison in the two segments, utilities and oil and gas groups, because of the peak in energy prices we saw in 2022 and going until the end of 2023 for utilities in the power market. So clearly what we see basically is this negative basis for comparison hit both segments operating performances. So that's really common between utilities and oil and gas names, but the difference comes from the fact that oil and gas players suffer on top of declining oil prices from still very low refining margins, and that's in relation to a continuing oversupply in the refining business, which is really a worldwide phenomenon. Going to the next slide, Thibaut, please. So in terms of guidance, so clearly, as you know, oil and gas players don't provide any EBITDA guidance for the full year, but we have them for utilities. What we see basically is that most guidances were affirmed during the H1 results presentations, and what we should see by the end of the year is utilities EBITDA predominantly lending stable or slightly up year on year. And that's in relation to, for instance, in the case of NG, hydro production in France picking up in H2 and offering, extra revenues to cushion the still negative basis for comparison in gas trading businesses. Now, going to guidances, I think there are three cases to highlight in our coverage universe. EDF, we believe that the issue affirming its full year EBITDA guidance is conservative after a very solid H1 performance due to a very strong cash EBITDA generation as well as strong trading revenues. So we are very optimistic for the rest of the year. Regarding Ørsted, the issue, and we'll get back to the case of Ørsted, which is really one of the key credit topics in our coverage universe. So Ørsted initially affirmed its full year EBITDA guidance during the H1 results presentation and then slightly adjusted it downward on lower wind speeds and some completion delay for a Taiwan-based project. And the last case, which is also interesting to point out, is Total. which announced recently some various initiatives for cash savings in the form of lower share buybacks, as well as OPEX and CAPEX efficiency plans now underway. And I think what's really interesting is that amid continuing uncertainty and pressure on the oil markets, the issuer is sending some positive credit signals to its investor base. So going forward, please, Thibaut. So now looking forward at commodity price trends, what we basically see is that there is a clear difference between utilities on the one end and oil and gas groups on the other. Why? Because as you can see on the charts left-hand side for power prices in France and Germany, what we are basically seeing now, so in France and Germany for power prices, is fairly stable prices after the very high peaks reached in 2022. Keeping in mind that there's a slight distinction to be made between France and Germany, and prices being relatively low in France compared to Germany reflect the French electricity market being slightly oversupplied as a result of EDF returning to normalized nuclear production levels. So what EDF gains on the one hand through positive volume developments, it loses it on the other hand through negative price developments. Now, looking at oil and gas groups, the story is a bit different because, as you can see, for the Brent spot prices, they have been very volatile over the past 12 months, and in a relatively oversupplied market worldwide, our oil and gas economist expects Brent prices to continue to trend downward and not to exceed $65 per barrel until the end of the first half of 2026. So clearly it shows how different the commodity price trends affecting oil and gas groups on the one hand and utilities groups on the other are for the time being. Going to the next slide, please, Thibaut. So turning to utilities now, I think there's a very interesting trend to highlight, which is an increasing focus on regulated activities. So this is really a trend that has been visible during the H1 results presentations. And clearly, this is a global trend shaping the industry because, as you know, with the accelerated deployment of renewable energy sources, there is growing need to strengthen and expand power networks. And these power networks are becoming really key to the acceleration of the energy transition. And in particular, what we see with the accelerated expansion of RES is that they create some congestion issues with the risk of some blackouts, as we saw in Spain in April, although the blackout was not caused by any locational congestion issue in the Spanish grid. Having said that, what we see looking at utilities CAPEX plans and the ones that were recently updated in our coverage universe, such as, for instance, with Iberdrola, is that clearly there's an increasing focus on power networks. Power networks becoming a sort of sweet spot of safe haven in the sector because, as you know, these assets are regulated, so they generate stable and predictable revenues. Generally, these revenues are inflation protected, and utilities in our coverage universe deploy these network assets in OECD countries with strong country fundamentals. So clearly what we see going to the CAPEX plans underway in our coverage universe is that for some issuers like EnBW, Enel, Iberdrola, and Naturgy, network CAPEX accounts for 50% or even more than 50% of the overall budget in the next years. In the case of ENGIE, what's really interesting, ENGIE is the sole operator of gas transmission and distribution assets in France. But as a result of its ambitions to accompany the energy transition, ENGIE is increasingly exposed to the development of transmission lines in the power sector. And you see that power networks could represent 15 to 20% of the entire expansion capex earmarked for 2025-2027, so which is really very substantial. And a final word to mention that for Iberdrola and EnBW, the recent capital increase announcements were actually driven by the ambition to accelerate investment step-up, investment effort in power networks. Next slide, please, Thibaut. Now, looking at the rating momentum in the sector, it's predominantly stable. Clearly, what you see is that the operating conditions are fairly stable for utilities. There's not been any major M&A transaction in the sector, and save for very specific circumstances like Ørsted, the regulatory environment has been neutral or even slightly positive. For utilities in our coverage universe. So with this in mind, what we see is clearly two issuers going into opposite directions in our coverage universe amid predominantly stable rating trends. EDF, which we expect to benefit from a one-notch upgrade at S&P early next year after the stabilization of the outlook on the BBB plus rating at Fitch earlier this month. And regarding Ørsted, what we see, despite the ongoing 60 billion Danish krone rights issue, there's still a risk of a downgrade to junk at S&P in relation to the various regulatory risk. In the US, after the stop work decision made by the Trump administration on one of the two offshore wind projects being developed by Ørsted in the US. And S&P made it clear that in the event of any of the two projects being stopped again by the administration, federal administration in the US, it could downgrade the BBB minus rating to junk, which could have some major implications, in particular in the hybrids segment. Going to the next slide, Thibaut. So I will be very short on this one regarding hybrids. Issuances are a technical factor to keep in mind in any sort of recommendations, and what we see clearly looking at all our issuers under coverage refinancing policies is that they have been very proactive, and we don't expect, save for Iberdrola, any massive issuance moves in the end of this year, save for Iberdrola, but which has some leeway given its recent 5 billion euros rights issue. And clearly what we see is that this is a very supportive element for issuers' ratings, because as you know, hybrids have become, for utilities and oil and gas companies, a stable component of their capital structure. Now, a few words to conclude with our intra-sector recommendation and matrices. Going to the next slide, Thibaut. So Thibaut made it clear that on the senior side, utilities are fairly expensive, but being defensive, we are overweight on an sector allocation basis. Regarding hybrids, as Thibaut mentioned, they have become expensive, save for few sweet spots like the call dates 28 and 29. So looking at both allocation matrices for senior and hybrid debts, what we have is an overweight on EDF and Veolia, an underweight on EDP and Ørsted. As for senior, we are also underweight on ENI, and as for hybrid debts, we are underweight on the Repsol. So as regards EDF, clearly I mentioned the positive rating momentum. We also see clear now conditions for the financing of new nuclear build in France, which actually was a main driver for Fitch affirming the BBB+ rating of EDF despite the sovereign downgrade. We also have a normalized nuclear production and attractive spread levels, which is the reason why we are overweight on the issuer on both senior debts and hybrid debts. Regarding Veolia, we like the operational trend the company displays, and we see a potential rating upgrade, which is a bit remote for the time being, which we could materialize in a few say 18 or 24 months at S&P, which could have a positive technical impact, which because it would bring the aggregate rating of Veolia's hybrid in the investment grade category. So clearly something to keep in mind for Veolia. Regarding Ørsted, basically we see continuing risk in the US in relation to the regulatory environment, and a threat of a downgrade of the senior rating of at S&P into junk. Given S&P's methodology for hybrids rating, a one-notch downgrade of the senior rating would have a two-notch implication at the hybrid level, which is the reason why we believe that for hybrids, but it's also true for senior debts, the ongoing risk displayed by the issuer is not proportionately remunerated. And finally, as regards EDP, we see the issuer posting fairly tight metrics for the BBB at S&P with tight spreads for both senior and hybrids. That's it now, and I give the floor to Baptiste for banks. Thank you.
Good afternoon, everybody. So it's my turn now. I'm going to present to you our outlook for European banks for the end of this year, also having in mind upcoming 2026. So on the first slide, you see that over the last few years, we have seen a strong profitability momentum for European banks, with a profit soaring, then stabilizing at high levels. This is on the back of mostly strong revenue, with dynamic net interest income, with rising fee and commission income, and with a stronger trading income, in particular for 25, with the market volatility of the spring. So in terms of outlook for banks' profitability, we are still positive. We believe it will remain pretty stable at those very high levels. Our profitability outlook is supported by very resilient revenues and four main drivers. The first driver being on the next slide, the still high net interest margins across most European banks. And we are only witnessing a limited decline in those net interest margins, despite the decreasing rate environment. This is supported on the next slide by the quick normalization of the deposit mix in banks' balance sheets, and this offsets at least partly the decrease of rates on the asset side. So this is a great support for the net interest margin. On top of the dynamic in deposits and in net interest margin, on the next slide, we see that lending volumes also support revenues and net interest income. So now we move more to a volume dynamic than to a real margin dynamic. And we also notice that lending to households seem to be more resilient to uncertainties than lending to corporates, a little bit what Thibaut mentioned earlier in the presentation. And last but not least, on the next slide, the fourth driver for our revenue outlook is a focus that banks are putting on non-interest income. So fee and commission income typically, and also to a lesser extent trading income, but mostly fee and commission income. And we are witnessing a number of bolt-on M&A moves in this field from banks that wishes to pivot towards more balanced bank insurance models. They want to diversify away from net interest income. And so we are also seeing a greater focus placed on increasing AUMs among most banks, in particular in the context of the shifting deposit mix. Banks try to recycle those term deposits in asset under management, and this is also supporting fee and commission income. So we are positive on revenues going forward, and we also support positive on charges. On the next slide, on the next two slides, you are seeing the trend that we are expecting on charges. So first operating cost, and then cost of risk. So operating costs are under control at most banks, with a cost-income ratio down and mostly stable. And we believe that it should continue to be this way, given ambitious cost-income ratio targets at most banks. And on the cost of risk side, which is on this slide, we believe they are very resilient at very low levels. And the limited deterioration that we sometimes witness is mostly due, in our view, to conservative provisioning rather than a real deterioration of asset quality. So it is a good use of the cost of risk budget by banks. I have in mind a few Italian banks, than a real deterioration of asset quality going forward. And we believe this trend will follow in the next months. In terms of balance sheet, on the next slide, we are also very positive. We believe banks' balance sheet to be very robust. So here we see the capital adequacy with capital ratio at high levels, ample buffers versus MDA. And on the next slide, we see the strong asset quality among banks with no pressure on this front, no identified deterioration. So I mean, non-performing loan, non-performing exposure ratio are very low and should remain at this level, given we don't anticipate any deterioration of the job market in 25 and 26, according to our economic research. So our outlook for European banks is positive across the board. We believe the fundamentals will remain strong and broadly stable over the next months, with maybe some rebalancing. For example, the revenue mix should evolve from net interest income to non-interest income. But all this should allow banks to weather any external shock going forward. However, we try to identify what could go wrong on the next slide. What could derail this nice momentum, and we are struggling to find a real systemic catalyst that could make things go wrong. We have listed a few threats here, but we don't think that there is a strong traction at the moment on those threats. Maybe the sovereign debt crisis could be the main focus, given what's happening in France. That could be leading the trend. But in our view, it is not yet on top of investors' mind, maybe not yet. And there we need a trigger to make it more systemic. So we don't see any real catalyst to make everything go bad. However, we also need to keep in mind possible idiosyncratic stories that could arise in even quiet or somewhat quiet times. In the banking sector, we saw Credit Suisse, SVB in 2023. I mean, banking sector was already pretty robust at that time. Maybe not as robust as today, but it was already okay. And we saw like a big Swiss bank failing, and US regional banks also having issues. So this cannot be ruled out. But from a systemic standpoint, we don't see anything going wrong in the foreseeable future. I wanted to say also a word on M&A on the next slide, because it's a very trendy topic. And this should support bank fundamentals and result in stronger banking groups going forward if things were to materialize. So we are seeing two trends from an M&A angle. So I already mentioned the bolt-on M&A, so I won't go back to it. But we are also seeing a broader consolidation move. The consolidation move is at play. We are we are seeing what's happening in Spain, in Italy, even across border between UniCredit and Commerzbank. And it is due to excess capital available at the moment, a need for banks to generate synergies, to grow, to diversify in a very competitive market. And we also have governments selling down their ownerships in banks, and this creates what I could call liquidity on the M&A market, with a few targets, a few restructured targets available for sale, and that could be of interest for potential buyers. So here we try to identify what's happening in this M&A trend. We see that the impact on profile is mostly positive. The impact of fundamentals is also broadly positive or stable, mostly positive for targets and stable for acquiring banks. And the impact on spread also is broadly positive, even if most of it, not most of it, but a few of those operations is already priced in spreads. So it means that to play this M&A angle, we need to move ahead with strong convictions, because there are a lot of uncertainties, obviously, in those deals. As long as they are discussed, it's uncertain what the outcome will be. But when they materialize, I mean, it's already too late to play it on the credit market. So it makes it pretty tricky to play. So all things considered, we are going to look at our relative value slides on the next 2 pages. Yes, next one, Thibaut. Yeah, thank you very much. And so how to play this outlook and this M&A trend on the bond market at the moment. So this is a very tight market with very tight spreads, and a market which is basically ignoring any negative news. Primary market has been very strong, even if investors have been a little bit more selective over the last 2-3 months. And we are also seeing a strong secondary market, which is mostly one way and kind of dry, with a lot of difficulties to find offers. So that's also why primary market is so strong. So in terms of multiple, here we are looking at spread multiples between different seniorities in the bank capital stack. So the relationship between tier 2s and senior non-pref and senior non-pref and senior pref look very tight. So which means that tier 2s and S&Ps are not so attractive at the moment. On the contrary, senior pref are back to the attractive territory against covered, and also because they are so close to S&Ps. And 81, as Thibaut already mentioned, still look attractive in terms of relative value and also in terms of carry. So what are our main ideas in terms of name by name trading or name by name opportunities on the next slide, on the next 2 slides actually. So we believe that this attractiveness in senior pref could be a good opportunity to play the decompression in this very tight market. In particular, it could be a good opportunity to play French names against Spanish and Italian names, maybe, which are having a strong momentum against French names. More selectively, it's also possible to play tier 2s against S&Ps as a decompression trade, but as both seniority are very tight, we'll have to be much more selective to pick the right bonds, especially in the senior non-preferred space. 81s they still offer value, but again on a bond by bond basis. For example, recently we published trade ideas, long trade ideas on SocGen and KBCBB against other 81s that looked much more rich to us. There are a few idiosyncratic stories to play across all seniorities. I would mention BAMIM on the back of the M&A situation. SocGen in the long run, even if the French noise could affect the performance of SocGen, but it's a good name to play. For example, on the next slide, Thibaut, please. SocGen could be a good name to play against other French names with a decompression trade approach. There are also idiosyncratic stories with ISPIM, UCGIM, and to a lesser extent, Crélan and Belfius. More specifically on French name, finally, we are seeing a structural deterioration of multiples of French banks against other European peers, which highlights some kind of repricing in the context of French political uncertainties. So this will limit the overperformance potential of most French names, despite very strong fundamentals. And names we believe are very attractive, especially in the buy and hold approach. So the conclusion and main takeaways on the next slide, Thibaut, please. Next one, yes, thank you. So we are in positive on European banks, as the fundamentals are still very strong in our view, on the profitability side and also on the balance sheet side. We think M&A is going to be an important topic and an important driver maybe for credit profiles in the next 12 months, as well as the resilience in the job market and the trend of the yield curve. And from a relative value standpoint, we are careful on French political risk. We think that Dutch banks are very rich, so we are underweight Dutch banks. And we don't see the same value in all seniorities. So senior pref, we are positive on senior pref. We are still constructive on 81, despite a rich asset class. I mean, carry is very good and the multiple are supportive. And we are much more negative on tier 2s and S&Ps that look rich to us. And so the main theme for Q4 in our view is the compression trades. And that's it on my side. Thank you very much.
Thank you, Baptiste. So just as a reminder, if I do the global conclusion of credit allocation, so what you need to keep in mind is that number one, even though spreads are globally tight, we don't believe that there is a significant risk of widening before the end of the year or even earlier next year. Long-term models are actually telling us that we are not so far from the fair value, at least in the low beta sphere. Same for tier 1, but it's true that it's not the case for some segments such as hybrids and high yield, which are admittedly quite expensive. Number two, so in terms of allocation for the low betas, we will prefer the senior preferred bank debt versus senior non-preferred, as Baptiste mentions. We'll prefer senior preferred bank debt versus corporate non-financials too. We continue to believe there is more value there, with fundamentals being better oriented in financials compared to corporates, despite the fact that there might be a bit more sensitive to the volatility coming from govies, particularly for France, given the fact that we have more French exposure in the banking indices compared to corporate. Number three, so in the high betas, so differentiation should be now take into place. So differentiation means continue to be long A tier 1 because there is good value and good carry there, still with fundamentals obviously helping the market. Continue to be long also in sub-insurance, but take profits from where we are, particularly in corporate hybrids, which was one of the big calls we did over the past 6 months. It is good to take some profits there, even though some hybrids could be continued to be kept in the portfolios or even reinforced when it comes to call dates in the region of 28, 29, as we mentioned, Ivan and myself. And high yield, again, as we mentioned, so probably better to be underweight at this stage, particularly in euro, slightly less in dollar than in euro. While if I go back to euro versus dollar, more underweight in dollar IG compared to euro, but more underweight in euro high yield compared to dollar high yield. That's it for the recap. So turning to the questions, I've seen that there was one question on the impact of First Brands Group default here from the auto parts. Obviously, that was let's say big default in terms of size, with around $6.5 billion of debt begin to default. What we actually think is that it was definitely an idiosyncratic story, because most of that default is coming actually from off-balance sheet debt, which was much higher than expected, even by the rating agencies. and some governance issues. So I'm not sure that it's representative of what is exactly the state of the auto parts industry, even though we know that the auto parts industry is definitely in a big challenging situation. If you have any question on that, interest on the sector, I recommend to contact directly Serge, who's the high-end analyst in the team and the expert in the auto parts particularly. But he actually believes that we have probably seen a turning point in terms of credit quality for the sector, given the fact that a couple of issuers are now focusing on deleveraging, particularly asset disposal. So it will probably make sure that the credit ratios of at least the big companies that we are looking at in that sector, such as Valeo, Forvia, Schaeffler, and ZF, could stabilize from where they are, which means that even though the premium for auto parts has decreased a lot over the past 2 months, from more than 100 basis points versus high yield to around 30 basis points now, there is still around 30 to 40 basis points of excess premium in auto parts, which are justified by fundamentals, but it's to us, it's probably an argument to be market weight, as we have actually shifted to market weight in auto parts and in autos. So with Serge and Valentin Maurice, who's covering the auto groups. It was back in August where we changed that recommendation from underweight to market weight for the auto groups and the auto parts. I'm not sure that there are some other questions.
On banks, maybe if I can say a word. Sure. I see 2 questions. One is more of a comment on the cyber risk and execution risk for M&A. Looking at other risks for banks, I mean, of course, cyber risk is an important one, especially as it has never really been tested. Execution risk for M&A is also a major one. I have in mind the Italian deal, the Monte Medio, which in our view contains a lot of execution risk, given the 2 different banks probably going to merge together and to have to work together. So this is important, but we could also mention other risks like something which is very looked at by French banks in particular, the neobanks and fintechs, with potential competition from people like Revolut for the retail, individual retail banks. So this is also a threat, but in the very short term, I don't see it as a catalyst to derail the current market momentum. For Santander 81, we need to check whether now the composite rating is IG. Of course, I mean, if the 81 of Santander is IG, it will be a big support for investors. Also having in mind that currently the 81 market doesn't really reflect. I mean, it's my view, but doesn't really reflect the idiosyncratic risk of issuers now. I mean, they are very compressed, they are very close to each other, and maybe Santander actually is suffering more from its non-investor friendly call policy than from its potential still high yield leg for 81. So I mean, it can always be a plus, but I think there are other things that play in this very hot and interesting 81 market at the moment.
Well, last, maybe there was 2 questions as you're actually turning to the primary market on hybrids for 2026. So unfortunately, I've not done that work already yet. What we can say, obviously, is that many of the supply coming on hybrids for 2025 was already some pre-financings of callable to 2026. So this is something we have definitely seen this year. Which means that the questions will be actually to anticipate the refinancings of H1 2027 potential call dates. So I will do the homework and come back to you there. So far, I don't have yet the figures, but I will come back to you.
Thank you, everyone. Thanks, Thibaut, Ivan, and Baptiste. If you have more questions after the call, don't hesitate to come through your sales contact or to the research team directly, and we'll be happy to share the support once available. Thank you very much, and have a good rest of the day. Bye-bye.
Thank you.
Thanks, everybody. Bye.
Thank you. Bye-bye.